They called it a crisis, a market correction, an unfortunate collapse of the housing sector that no one could have predicted. But that's not what happened in 2008. What happened was systematic, calculated, and worst of all, legal. While 13 million Americans lost their homes, the men who engineered the disaster walked away with billions. Not one of them went to jail. Not one executive from the major banks faced criminal charges. Instead, they got bonuses. They got bailouts. They got rewarded for burning down the economy. And here's what should terrify you. They're doing it again. Right now. The same playbook. The same schemes. Just with different packaging. Let me show you how they pulled off the greatest haste in American history. It starts in the 1990s. The American dream is alive and well. You work hard, you save money, you buy a house, simple. Banks had been doing mortgages the same way for decades. You walk into a bank, you prove you have income, you put 20% down. The bank checks your credit. If everything looks good, you get a 30-year fixed mortgage at around 7 or 8%. And here's the key part. The bank keeps that loan. They service it. They collect your payments every month for 30 years. Which means the bank has every reason to make sure you can actually afford the house. Because if you default, they lose money. This system worked. It was boring. It was stable. Banks made steady profits. Families built equity. The housing market grew at a reasonable pace of about 3% per year. Nothing sexy. Nothing explosive. Just solid, predictable growth. But boring doesn't make investment bankers rich. In the late 90s, something changed. Investment banks realized they could turn mortgages into a product. Not just a loan between a bank and a homeowner, but a tradable security that could be sold to investors worldwide. They called it securitization. Here's how it worked. A bank gives you a mortgage. But instead of keeping it, they immediately sell it to an investment bank. That investment bank pools your mortgage with thousands of others. They slice this pool into different layers, called tranches. Then they sell shares of these mortgage pools to investors as bonds, pension funds, insurance companies, foreign governments. Everyone wanted a piece because these bonds paid higher returns than Treasury bonds, and they were supposedly just as safe. After all, they were backed by American real estate. And everyone knows real estate only goes up. Right? This is where the incentives broke. Remember the old system. The bank kept your loan, so they cared whether you could pay. But now, the bank that gives you the mortgage sells it within weeks. They don't care if you default. They already got paid. The investment bank that buys it. They slice it up and sell it to someone else. They don't care either. The investors who buy the bonds. They're so far removed from you, the actual homeowner. They have no idea if you're a doctor with perfect credit or a part-time dog walker with no savings. Nobody in the chain had any skin in the game anymore, and Wall Street realized something beautiful. If we can sell these mortgages to someone else immediately, why be picky about who we lend to? The more mortgages we make, the more we can securitize. The more we securitize, the more fees we collect. So the message went down from the investment banks to the mortgage brokers. We need more loans. Lots more loans. Enter the subprime mortgage. These weren't your grandfather's mortgages. These were loans designed to fail. They targeted people who couldn't afford homes under the old rules. No income verification. No down payment. Terrible credit scores. Didn't matter. You got approved. They invented products with names that should have been red flags. NJ loans. No income, no job, no assets. Interest. Only mortgages where your payment doesn't even touch the principal. Adjustable rate mortgages that started at 2%, then jumped to 9% after 2 years. Mortgage brokers weren't bankers anymore. They were salesmen working on commission. The more loans they closed, the more money they made. They didn't explain the terms. They didn't warn people about balloon payments. They told families making $40,000 a year they could afford a $500,000 house. And people believed them, because the broker was wearing a suit, because everyone else on the block was doing it, because someone official was telling them this was possible. By 2005, nearly 20% of all new mortgages were subprime. The machine was running at full speed. Homes that sat empty for years suddenly had buyers. Prices skyrocketed. In Las Vegas, Phoenix, Miami, and California, home values doubled in 5 years. People started treating houses like lottery tickets. Buy a property. Wait 6 months. Flip it for a $100,000 profit. Everyone was getting rich. Real estate agents, mortgage brokers, investment bankers, homeowners. Even people who had no business owning property were pulling equity out of their homes and buying investment properties. The Fed saw all this. They saw housing prices detaching from reality. They saw the explosion of exotic mortgages. Alan Greenspan, the chairman of the Federal Reserve, called it froth in certain markets. Froth, not a bubble, not a crisis, just a little froth. He kept interest rates low. He encouraged the party to continue. Wall Street loved him for it. But there was a problem lurking underneath. These mortgage-backed securities were supposed to be safe because they were diversified. Thousands of mortgages from all over the country pooled together. The thinking was, sure, some people will default. But they won't all default at the same time. Real estate is local. If Vegas has problems, that won't affect Boston. Except they were all built on the same lie, that home prices would keep rising forever. In 2006, something strange started happening. Home prices stopped going up, then they started falling, not crashing, just slowing down. But that was enough. Those adjustable rate mortgages started resetting. Suddenly, families with 2% rates were facing 9% rates. Monthly payments doubled. People who could barely afford the teaser rate had no chance with the real rate. Default started. Slowly at first, then faster. And that's when Wall Street discovered something terrifying. Those mortgage-backed securities they'd been selling as safe investments. Nobody actually knew what was in them. The pools were so complex, so sliced and re-sliced, that even the banks that created them couldn't tell you which mortgages were good and which were garbage. They'd mixed prime loans with subprime loans with loans to people who didn't even exist. The entire system was built on mortgages that were designed to explode. But to understand how catastrophic this became, and how the banks turned this disaster into the biggest theft in history, we have to look at the hidden weapon they used. The weapon had an innocent name. Credit default swaps, CDS for short. Wall Street called them insurance. But they weren't insurance. They were bets. Unregulated, unlimited bets on whether mortgage bonds would fail. Here's how it worked. Let's say you're an investor, and you own $100 million in mortgage-backed securities. You're getting nervous. Defaults are rising. So you go to an insurance company like AIG and you buy a credit default swap. You pay them a small premium every year, and if your bonds fail, AIG pays you the full $100 million. Sounds reasonable, right? That's actual insurance. But here's the twist. You didn't need to own the bonds to buy the insurance. Anyone could buy a credit default swap on any mortgage security. It would be like buying fire insurance on your neighbor's house. You don't own it. You don't live there. But if it burns down, you get paid. Now imagine 100 people buying fire insurance on that same house. And imagine they're all walking around with gasoline and matches. That's what happened. Hedge funds who knew these mortgages were toxic started buying credit default swaps by the billions. They were betting on failure. The more mortgages that defaulted, the more money they made. Goldman Sachs was selling mortgage bonds to their clients with one hand, while buying credit default swaps against those same bonds with the other. They were literally betting their own products would fail, and they didn't tell their clients. One trader at Goldman Sachs sent an email that later became infamous. Boy, that Timberwolf was one shitty deal. Timberwolf was a mortgage security Goldman had just sold to investors for $1 billion. The trader knew it was garbage, but they sold it anyway. Then they shorted it. AIG sold over $500 billion worth of credit default swaps. $500 billion. They collected premiums like an insurance company, but they didn't set aside reserves like an insurance company. They thought the payouts would never come. After all, housing prices don't fall nationwide. That had never happened before, until it did. By late 2007, the defaults were accelerating. Those mortgage-backed securities were collapsing. And suddenly AIG owed hundreds of billions of dollars it didn't have. The biggest insurance company in the world was about to implode. And if AIG went down, every bank that bought credit default swaps from them would lose their insurance, which meant those banks would collapse too. Goldman Sachs, Morgan Stanley, Bank of America, Citigroup. All of them were exposed. Bear Stearns was the first to fall. March 2008. They'd borrowed $33 for every $1 they actually had. That's not banking, that's gambling. When the mortgage bonds collapsed, Bear Stearns collapsed with them. The Fed forced JP Morgan to buy them for $2 a share. A company that had been worth $18 billion sold for $240 million. A 99% loss. Wall Street panicked. If Bear Stearns could die, anyone could die. 6 months later, Lehman Brothers filed for bankruptcy. $619 billion in assets. The largest bankruptcy in American history. The stock market crashed. Credit froze. Banks stopped lending to each other because nobody knew who was holding the toxic mortgages. The entire financial system was hours away from total collapse. And this is where the robbery happened. Treasury Secretary Hank Paulson, former CEO of Goldman Sachs, went to Congress. He told them the world was ending. He needed $700 billion immediately. No oversight, no conditions. Just hand over the money or the economy dies. Congress had 48 hours to decide. They called it the Troubled Asset Relief Program. TARP. The idea, they said, was to buy up all those toxic mortgage assets from the banks, clean up the mess, stabilize the system. But that's not what happened. The banks got the money, all of it. But they didn't use it to buy toxic assets. They used it to plug their own holes, to pay bonuses, to buy smaller banks. Paulson gave $85 billion to AIG. Why? Because AIG owed money to Goldman Sachs, Morgan Stanley, and every other major bank. If AIG failed, those banks wouldn't get paid on their credit default swaps. So taxpayers bailed out AIG, and AIG immediately turned around and paid Goldman Sachs and the others 100 cents on the dollar. Goldman Sachs alone got $13 billion through the AIG bailout. Paulson's former company, the company where he still had $600 million in stock, and he made sure they got every penny. But here's what makes it a robbery instead of just a bailout. 0 executives went to jail. 0. The Department of Justice investigated. They had the evidence, emails showing fraud, documents proving executives knew they were selling toxic products, testimony from whistleblowers, but no criminal charges. Not for the CEOs, not for the traders, not for anyone who mattered. You know who did go to jail? One mid-level Credit Suisse banker. That's it. One person for the entire financial crisis that destroyed 13 million families. Meanwhile, the banks paid fines. Billions in fines, the headline said. Bank of America paid $16.65 billion. Sounds like justice, right? Except Bank of America made $1.7 trillion the year they paid that fine. The fine was less than 1% of their revenue, and it was tax deductible. The shareholders paid the fine, not the executives, not the traders who committed fraud. The punishment for the greatest financial crime in history was a parking ticket. Even better, the banks that caused the crisis got bigger. Way bigger. JP Morgan bought Bear Stearns and Washington Mutual. Bank of America bought Merrill Lynch and Countrywide. Wells Fargo bought Wachovia. The government said these banks were too big to fail in 2008, so they made them bigger. Today, the top 4 banks control more of the financial system than they did before the crash, and the executives, they kept their money. Dick Fuld, CEO of Lehman Brothers, walked away with over $500 million. Stan O'Neill at Merrill Lynch got a $160 million retirement package after driving his company into the ground. Angelo Mozilo at Countrywide, the man who personally approved the worst subprime loans in history, paid a $67 million fine, but kept $470 million in previous compensation. The robbery wasn't just the bailout. It was the entire architecture of who paid and who profited. 13 million families lost their homes. 9 million people lost their jobs. $19 trillion in household wealth evaporated. Retirement accounts cut in half. People who had worked their entire lives, who had played by the rules, lost everything. And the banks, they're making record profits again. The traders got their bonuses back within 2 years. The system that broke the economy didn't change. It got reinforced. Congress passed Dodd-Frank, a 2,000-page law meant to prevent another crisis. The banks spent billions lobbying to weaken it, and it worked. Most of the key provisions got delayed, watered down, or eliminated. In 2018, Congress rolled back major parts of Dodd-Frank, claiming it was too hard on small banks. The bill was written by bank lobbyists. The message was clear. Heads they win. Tails you lose. Take massive risks. If the bets pay off, keep the billions. If the bets blow up, the government will save you. The profits are private. The losses are public. But here's what should keep you awake at night. They didn't learn to stop. They learned they could get away with it. And right now, in 2025, the exact same patterns are emerging again. Different products. Same scam, the loans are back. Not mortgages this time, something bigger. Corporate debt. Private equity leveraged buyouts. Commercial real estate. And the new favorite say, collateralized loan obligations. CIOs sound familiar. It should. CIOs are the direct descendants of those mortgage-backed securities that destroyed the economy. Same structure, same logic, same lies. Banks make risky loans to over-leverage companies. Then they bundle those loans together, slice them into tranches, and sell them to investors as safe securities. The rating agencies, the same ones that called subprime mortgages AAA, are now calling these CLOs AAA. There's over $1.4 trillion in CLOs floating around the financial system right now. Pension funds own them. Insurance companies own them. Your retirement account probably owns them. And just like 2008, nobody actually knows what's inside them. The loans backing these CLOs are called leveraged loans. They're made to companies that are already drowning in debt. Companies that can barely make their interest payments. The terms are even worse than subprime mortgages. Covenant-light loans, they call them. That means the company borrowing the money doesn't have to maintain any financial standards. They can pile on more debt. They can pay themselves dividends even as they're failing. And the lender has no recourse until the company completely collapses. 80% of leveraged loans issued today are covenant-light. In 2007, before the crash, it was 30%. We've tripled down on the riskiest structure, and the banks have learned new tricks. They don't keep these loans on their books anymore, so they face zero consequences if they blow up. Private equity firms are loading companies with debt, extracting all the cash through special dividends, and leaving the company as a corpse. When it fails, the workers lose their jobs, the suppliers don't get paid, but the private equity guys already cashed out. They made billions from Toys R Us doing exactly this. 17,000 people lost their jobs. Bain Capital and KKR walked away with $200 million each. Commercial real estate is the next bomb waiting to explode. Office buildings are empty. Nobody's going back to the office 5 days a week. Companies are cutting their space in half. Those buildings were financed with massive loans, based on occupancy rates and rental income that no longer exist. $1,200 billion in commercial real estate loans are coming due between now and 2025. Most of those properties are worth 30 to 50% less than when the loans were made. The banks are extending and pretending, pushing the problem down the road, hoping something changes. It won't. The regional banks are especially exposed. Remember Silicon Valley Bank? It collapsed in March 2023. Signature Bank went down the same week. First Republic failed 2 months later. These weren't accidents. They were warnings. Small banks without the political connections to get bailed out. The Fed stepped in with emergency lending programs, but they didn't fix the underlying problem. They just pushed the collapse forward. And here's the beautiful part for the big banks. When regional banks fail, JP Morgan and Bank of America swoop in and buy the pieces. First Republic was seized by regulators and immediately sold to JP Morgan, the same playbook as 2008. Crisis creates opportunity for consolidation, but the real systemic risk is in the shadows. The derivatives market has exploded since 2008. It's now worth over $600 trillion. $600 trillion. That's 40 times the entire US economy. These are complex bets on bets on bets. Interest rate swaps, currency derivatives, credit default swaps, yes, still. The same weapons that detonated in 2008 are bigger than ever. The Dodd-Frank rules that were supposed to regulate derivatives. Gutted. The banks lobbied to carve out exemptions for nearly everything. Today, 70% of the derivatives market is exempt from clearing requirements. That means there's no central authority tracking who owes what to whom. If one major bank fails, the contagion could spread faster than regulators can even map it. And the Federal Reserve is trapped. They raised interest rates to fight inflation, but now they can't raise them much more without triggering defaults across the corporate sector. Zombie companies that have survived on cheap debt for 15 years can't handle 7% interest rates. If the Fed keeps rates high, defaults surge, CLOs collapse, banks fail. But if they cut rates too soon, inflation roars back and destroys purchasing power for regular Americans. Heads they win. Tails you lose. The people who engineered 2008 are still in charge. Jamie Dimon at JP Morgan, David Solomon at Goldman Sachs, Brian Moynihan at Bank of America. These aren't rebels who reformed a broken system. They're the inheritors and defenders of it. They spent the last 15 years consolidating power, buying politicians, and convincing everyone that actually, banks are more stable now. Trust us. But the math doesn't lie. Bank assets to GDP are higher now than before 2008. Leverage ratios are creeping back up. The derivatives exposure is exponentially larger. And the moral hazard is complete. Everyone knows the government will step in. Too big to fail became official policy. So what happens next? Maybe nothing for a while. Maybe the can gets kicked down the road for another few years. Cheap debt and accounting tricks can hide a lot of rot. But eventually, something breaks. A major corporate default. A commercial real estate cascade. A derivatives counterparty that can't pay. And when it breaks, it will break faster and harder than 2008 because the system is more interconnected, more leveraged, and more concentrated than ever. And when it happens, watch what they do. They'll act surprised. Shocked. Nobody could have seen this coming, they'll say. They'll call it a black swan event, an unforeseeable market disruption. The Treasury Secretary, probably from Goldman Sachs or JP Morgan again, will go to Congress demanding another bailout. Trillions this time, not billions. And Congress will cave. Because the alternative is watching the ATMs stop working. The executives will keep their jobs. They'll pay fines that sound big, but mean nothing. A few mid-level traders might go to jail if the public outrage gets too loud. But the architects will walk. They'll write books about the crisis. They'll go on speaking tours. They'll get hired as consultants to prevent the next crisis, which is like hiring an arsonist as your fire safety inspector. And you'll pay for it, in higher taxes or inflation or a decade of economic stagnation. Your retirement will take another hit. Your wages will stagnate. Your kids will inherit an even more rigged system. This is the pattern. This is the scam. And it works because we let it work. In 2008, people were angry. Occupy Wall Street filled the streets. But nothing changed because anger without accountability is just noise. The system absorbed the rage and moved on. They learned they don't need to change. They just need to wait out the anger. So here's the uncomfortable truth. 2008 wasn't a crash. It was a proof of concept. It proved that banks can commit fraud at scale, destroy millions of lives, and face zero real consequences. It proved that privatized gains and socialized losses isn't just a cynical talking point. It's the actual structure of American capitalism. It proved that the government will always choose banks over people when forced to decide. And they're doing it again because the first time worked perfectly. For them. You want to know why wealth inequality is at levels not seen since the Gilded Age? This is why. You want to know why millennials and Gen Z can't afford homes? This is why. You want to know why trust in institutions is collapsing? Because the institutions prove they serve wealth, not people. The robbery continues because we've accepted that this is just how things work. That finance is too complex for regular people to understand, that we need these big banks because they're the engine of growth. But that's the final con, the biggest lie. We don't need banks that gamble with our economy. We need banks that do boring things, take deposits, make loans, facilitate payments, that's it. Everything else, all the derivatives and structured products and leveraged buyouts, isn't economic productivity, it's extraction. It's taking wealth that other people created and funneling it upward through financial engineering. The system won't reform itself. Power never regulates itself. Change only happens when the cost of not changing becomes unbearable. When enough people understand that 2008 wasn't a natural disaster, it was a crime, and the criminals are still running the bank. So pay attention. When the next crisis hits, and it will, don't let them call it a crash. Don't let them act surprised. Don't let them walk away again, because it's not a market failure. It's not a financial crisis. It's a robbery. And this time, we should at least call it what it is.